Our next topic is banking after money. As we are aware about the term bank, but the actual and technical definition of bank is an institution which can accept deposits and lend money to their borrowers. The institution qualify as a bank by fulfilling the both of above set conditions. The both of above set conditions are also represented through the given picture, where primary functions of a commercial bank is given, which are two primary functions: accepting deposit and lending money. It combines and create the definition of bank. Let's assume that if an institution perform only one operation out of the given two, generally called as non-banking financial company. We take an example like Life Insurance Corporation of India. In short, we known as LIC. It is a non-banking institution because it perform only one operation out of two. He gen- it generally accept deposit from the public. LIC will not lending money to the public, so it is called as non-banking financial company. Banking is a very vast topic, but only limited aspects of banking are included in our curriculum or course. We have only two aspects as you see in the picture. First is credit and money creation by commercial banks. Second is the function of central bank. Before taking up the topic, we have to discuss the structure of banking in a country. There are two types of bank in a banking system of a country. First, central bank. It does not deal with public. It generally supervises the commercial banks like RBI, Reserve Bank of India doing in our country. The second type is commercial bank. They deal with public and covered under the definition of banks. So we are taking the topic credit creation by commercial banks. Function of central bank will cover in the next chapter. So let's start the credit creation by commercial banks. So in this we have we have the part commercial bank does not print the money. As we are aware that the currency authority in our country is the central bank known as Central Bank of India. Currency is printed by by central banks, not by commercial banks. So commercial bank create money by creating demand deposit. They don't print the money, but they create money by creating demand deposits. And with reference to demand deposit, we study the concept of demand deposit in money supply. So it means when public or depositor deposit their money with commercial banks, the banks will lends the money to the borrowers. Credit creation of commercial banks are some other name also as money creation. So the answer for the credit creation or money creation by commercial bank will be the same. So let's understand the credit creation process by the by the various pictures. So we start from the first part of this process. First part, banks accept deposit from their customer. As we aware or know, that the bank are accept deposits from their customer. This is the primary function of a bank. But this deposit this deposit have interest liability on the bank. So the second part is banks gives interest on the deposits of their customers. As we can see in picture, the, the customer made deposit to the bank and bank provide interest to their depositor, as we know. So this is the two part of that process. First, the bank accept deposit to from their customer. Second, bank give interest on deposits to their customer. So we move to the third part. Simultaneously, bank will provide the instant withdrawal facility to their depositors. It means depositors or customers of bank will go to the bank and withdraw their money at any time. This is the third part. And the fourth part is the bank lends the deposits of their customer and earn interest. This is the part by which a bank earn profit. But let note that the two part of this process, it means the part 3, when customer will provide the instant withdrawal facility by commercial banks, and second and the fourth part, the lending of deposits of their customers and earn interest on it by commercial banks, are contradictory to each other. So so the this contradictory situation is resolved by the experiences of bank, that the all of the customer will not come to withdraw their money at a same time. Banks are required to keep a certain amount as cash reserve, generally known as legal reserve ratio, or LRR, with them for serving cash requirement of depositor. So from this, a bank will decide that how much money they have to kept with him to serve the cash requirement of the customers. This cash reserve ratio will decide the rate of money creation of commercial bank. For this, we can see an example. The example is represented in the picture. As seen in a picture, a bank account holder of a bank deposit rupees 1000 to his bank account. The present cash reserve ratio or legal reserve ratio is 0.1 or 10% of the deposits. So the bank will give 90%, rupees 900 loan on their deposits, keeping 10% rupees 100 in cash reserve, because we state in the starting the cash reserve or LLR is 10% of deposit. This is the initial round. In initial round, the customer deposited 1000 rupee in her and his account. The 90% of deposited amount loan to some other customer, and 10% make to cash reserves. So the loan amount is given through check to a borrower. 900 rupees of loan of 900 rupees will give through a check to a borrower. The borrower will deposit the 900 check in his bank account. So the same process repeated. 90% 90% of 900. It means 8 rupees 810 810 loan to the loan is provided to some other customer, and 10% of 900, it means 90 kept with cash reserves as LRR. This process is carried out till the deposits will zero. From there, a question arises that how much credit create by the banks. The answer of that exists in a phenomena is called money multiplier. This is also represented in that example. Money multiplier is equal to 1 upon LRR. It means if the LLR is 10% of deposits, the initial deposit will increase by 10 times. So if initially we invested 1000 in the bank amount, and money multiplier is 10, so the total credit creation by bank is 10,000, because as you seen in example, initial deposit into 1 upon LLR. So initial deposit is 1000, 1 upon LLR value is 10. 100, 1000 into 10 is 10,000. So the total money creation by a commercial bank is 10,000, in which 10% is LLR. So the 10% of 10,000 is 1,000, which is seen in the LLR. The total of cash reserve is 1,000, and the loan amount is now 9,000, because 10,000 minus 1,000 is 9,000. Or as we know, the credit creation or loan is 90% of deposited. It include, so the formula of an explanation of money multiplier is also given in our picture. So money multiplier will decide the amount of credit created by commercial banks. So money multiplier is equal to 1 upon LLR, legal reserve or required reserve ratio. So it decides the overall credit creation of commercial banks.